Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we are looking at Hershey Company. The Hershey Company is one of the largest confectionery manufacturer in the United States. It has over 100 brand names and over 80 different countries. The company has successfully built strong brands with a lasting pricing power and benefits from real manufacturing cost advantage. This is one of the companies that I've included in the portfolio not long ago, and what I would like to do today is to give you an overview of this company. But before we do that, I would like you to subscribe to the channel. If you have any questions, let me know, and of course like the videos. As well as that, if you can also join us on the Patreon account, that would be absolutely amazing, where you get access to all the buys, all the sales that I'm making in real time. You get the stock watch list, which I'm updating right now. You get the dividend calendar spreadsheet. You got the Sharia compliant investing ebook, as well as, of course, the Discord access, which is basically a place where a lot of brothers right now are sharing a very, very good practices. Right, so the company that we're talking about today is the Hershey Company. This company sells, like I said at the beginning, sells all sorts of snacks, over 100 brands. Right now, the company is down, for the 1 year, it's down almost 16%. It has a PE right now, forward PE of less than 20. And as you can see here from the rating summary here, Seeking Alpha Analyst is actually saying it's a buy. Quant and Wall Street is actually saying it's a hold. Now, looking at the financials, so that's what we're going to do first. Then we're going to look at the dividends. Then we're going to look at the valuations. And then at the end, I'm going to give you my own valuations where I think the price should be in the next in 12 months. So in 2013, their revenue, so if I can zoom in, their revenues was $7 billion. 7.4, 7.3, 7.4, 7.5, 7.7, 7.9, 8.1, 8.9, 10.4, 11.1. So it has actually gradually increased in the last 10 years, which is quite nice. That's what you want to see, is you want to see a growing revenue from this type of businesses. Now, in terms of net income, from 180 and 820 million to right now 1.9 billion, which is quite good. So 1.9 billion dollars. So that's a increase almost every single year. And it had a little bit of decline, but it bounced back again in 20. Has it had any declines? Actually, no, it hasn't. It's been increasing almost every single year since then. So the net income has actually been heading in the right direction. I think it was only with this year, that is 20, that year basically has a little bit of a decline. Other than that, it's actually been increasing every single year. As you can see, 2015 was the only year. So yeah, so the net income seems absolutely fine. In terms of total revenues, absolutely fine. Now what we're going to do is from dividend side of things and a couple of other metrics as well. As you can see here, it has a market cap of $38.4 billion. So it's a large cap, 2.54 dividend yield, which is quite nice. And one of the reasons I actually, in fact, let me go back here and show you, okay, if we do 5 years, the price, okay, even within a year, I think it would be okay. So at one point, the price was $274. Now, that's the highest it's been is 276, and right now is 187. So at one point, it was really overvalued, really overvalued. And the two reasons the price went down is, of course, it was overvalued at one point, as well as that this is one of the companies that the entry to this industry is quite easy. Okay, so the barriers to entry in this industry is quite actually not as challenging as other industries, meaning I can, if I have the money today, I can open up a business that sells more or less similar sort of snacks. Of course, it's not going to be, maybe the quality might not be the same, or maybe it could be the quality the same, but same pricing and all of that stuff. But the company's been around for a long time, so they do have that pricing power over their competitors. And it does, I think it does have a wide economic mode. If we check here, yeah, it has a wide economic mode. So that's one of the reasons it has come down quite a bit, sort of from 276 right now to 178. And this type of things can easily happen when companies actually shot up so much to the point where people then realize when the valuation doesn't add up, of course, then it's going to tank because people are going to sell and realize, okay, I'm going to take some gains off the table. Right. Looking at a couple of more things. The payout ratio is right now 45%. latest increase with 15% and the 5-year growth rate of 9%. Last 20 years is about 10%. So it's growing very fast right now as we speak. And as you can see here, it's been going up every single year in the last since 2004. So that's 13 years of increasing that dividend, and without a reduction, 93 years. So in terms of dividend, absolutely solid, no issues with that. You get $4.77 for every share of this company that you own, which is quite generous. Okay, and it looks like it's undervalued based on the dividend yield method. So right now the 5-year average is 2.03, but 2.54 is where it is. So if the current dividend yield is higher than the 5-year average, then that means, okay, according to the dividend yield method, okay, it's undervalued. And the 5-year average for the PE is 24. Right now we're looking about 19. So again, in terms of PE as well, it actually seems undervalued, but in terms of the consumer staples sector, is almost identical to the rest of the sector. Now looking at the earnings per share payout ratio, 70 is what we normally okay with, below 70 I mean, and right now it's about 49. Going forward is also again going forward is next 12 months will be 49. Right now it's about 45. Earnings per share has been growing every single year since 2013, as you can see here, $3.72 to right now expected for the next 12 months about $9.70, which is quite nice. Free cash flow per share is also growing in the right direction. Shares outstanding has been declining, which is quite nice. So they have been buying, not a lot, but they have been buying their shares basically from 220 to right now 206. Okay, total sales, by the way, that's in the millions. Total sales in the last 10 years, we're looking at about 7.15 to right now 11.2, which is what we've seen early. Return on equity, we're looking at about 54%, and return on invested capital, we're looking at 27%, which is quite nice. Operating margins of 23%, and a free cash flow margin of 15%, which is absolutely solid. And final thing, net debt to EBITDA right now, we're looking below 4 is what we prefer in this sector. And right now in this consumer and stable sector, right now it's 1.49, which is absolutely perfect. Now, going back to Morningstar, you can see here it's a 4-star valuation right now, which is means it's quite cheap. So 5% discounted right now, $179 per share is where they think the price should be. Right now it's $187. So it's about $10 from where it is. In fact, it should be, is heading towards that fair valued right now rather than discounted a lot. So 5% isn't really much, and it does has a wide economic moat. When I show you next thing, I'm going to show you Australian returns. So the last 10 years, okay, the company has to return total returns of 10, basically about 8%, 8.5% total return in the last 10 years. Now they are expecting the earnings to grow about 7% for the next 5 years. So this year coming is about 5%. After that is 7.27. So when I did my discounted cash flow model, I actually used 6% just to kind of give myself a little bit of room. Okay, because 6% and 7% might happen, it might not happen. So for margin of safety, I actually used the 6% instead of that. Now, a couple of more things I want to share with you guys before we move on to the final valuation. And that's going back to Seeking Alpha, go to earnings, for example, and go into earnings estimates for the next couple of years. So as you can see here, 2023, they're expecting once the final report comes out, it's about 12% growth, then about 5% every year following basically 2-3 years, which is quite nice for this type of business, right? And then 7.8, 4.5, sorry, 3.5 again, and 4%. So which is absolutely fine. Again, this is the type of business that grows their business, their top line and bottom lines about 5% to 10% every single year. So that's basically what you expected from this type of business. Looking at the model here, okay, my own. So Morningstar, we've already seen is $179 per share. Dividend discount model actually has given me 236. Multiples valuation is giving me 187. Discounted cash flow model is giving me 178. Seeking Alpha was 210. So average out the 5, you get $201.86 right now. So stock price right now, we're looking at 187. That gives us about 8% difference from where we are now. So that's an upside. Now, if I use 5% margin of safety just for this type of business, 5% should be enough. If you want to do more, you of course feel free to do that. But margin of safety about 5%, so it gives you a buy price of $191 per share, and it's a buy right now. If you think, okay, maybe I just need a little bit more than that, then it's actually, you can do 10% and maybe wait for a little bit to actually bounce back, or maybe just to drop down a little bit, and you might get that chance. Even if you want to do 15% and to be really safe, $171 per share. Now, I'm sure it has hit, what was the lowest? 178 was the lowest it's been. Right now, if you look at this, is 171, so it could potentially come down to that, but I can't see a situation where that might happen. To be honest, it can happen. Anything can happen these days. Right, just to be transparent, I do own 25.6 shares of this company, and is one of the companies that I've actually been buying a lot lately. So if I show you, I think other than the dividends that they paid me, if you look at it, I've been buying I bought 2 shares in January. December, I bought 1.7 again. So I have been buying quite a lot, and they have paid me about $8 in dividends recently. So there you go. So that's what I wanted to share with you guys today. If you enjoy this type of content, you like the transparency, what we're trying to do here, what we're trying to achieve here, I would absolutely love you to join us on the Patreon if you can. And if you can't do that, just like the video, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.